Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Hello and welcome back to our weekly research meeting here at McNichol & Associates Asset Management. Each week, our team breaks down markets, economic data, and how we see the world in real time. If you're joining us from our YouTube channel, make sure you like, subscribe, and comment below if you have any questions. If you want to learn more, go to mam.ca, that's our Canadian website, or mcnichol.com, that's our US website. So today we're going to start off with Joe Pochodyniak and talking about everything related to alternative assets and a deeper dive into the general market. So Joe, over to you.
I just wanted to update the group on an exit announcement relating to one of our portfolio companies. And so we'll get started from the beginning here. In and around 2018, and by the way, the disclaimer drawing your attention to the fact that we're not providing direct investment advice here. So today we're going to be focusing on part of our alternative program called the Emergence Fund. This is our private equity fund, and in and around 2018, we made an equity co-investment with a group called 424 Capital to take a position in a company called LearnWell. So LearnWell is a academic progress and mental health treatment company that mainly helps children and younger adults transition back to a more academic traditional school environment. This is an area that has been grossly under resourced and under supported in the United States. And at the time that we took our position, it was still very much a startup. And so, again, the original investment occurred in 2018. And just sort of by way of background, how we came to discover the company was through a read-through of the financial statements of another sponsor who is well known to us, good group, trusted their judgment, and did a little bit more exploring into the total addressable market that a company like this and others like it can serve. And so fast forward to late yesterday, it was revealed that Goldman Sachs's alternative asset division basically took out the company at 11 times the price we paid. And so the thesis here really was that behavioral health and sort of that focus on mental health could very easily turn from sort of a regional startup to a very large business. And that actually proved to be correct. And so this particular company started off with just a couple of clinics in, I believe, 7 states. And last year they helped 51,000 kids and actually executed over 120,000 individual counseling visits. The revenues have grown from $7 million to over $50 million, and they're now in 36 states and counting. And I think Goldman Sachs is a good partner for them. I expect that they'll probably take this, fully national across the United States and potentially launch it as a public company somewhere down the line. But very, very pleased with this one, and a big win for the Emergence Fund here today. Just transitioning into the technical part. So this is a technician by the name of Andrew Adams. He still feels that the bull market is definitely there. The evidence is sort of on the side of the bulls for now. However, the markets are appearing to be more and more toppy. And so what that means is with each, move higher, you do get a subsequent sell-off. So people are very much, I think selling it to strength. And we talked offline about some of the challenges in software companies and the like. And so here's the S&P 500 index. And the real messaging here is that as long as it can maintain its position within this upward sloping wedge, it should be still a good time to invest in equities. On the other hand, if you get sort of a sustained breakdown, it may be an opportunity to look elsewhere. Breakouts to these new all-time highs are obviously bullish. That's sort of obvious, I think, to everyone on this call and others watching it. But again, the issue here is more going back to that period in March and April, and then in June. And so I think this slide is probably the main one from the presentation. You can actually see these lines that Andrew's drawn in here, indicating that the index has done an amicable or admirable, I should say, job of reaching these new highs, but it does sell off pretty quickly after making a new high. So there could be some reluctance on the part of investors to maybe be the one holding the punch bowl at the end of the party. This is another look at the market. This particular look at the market focuses on mostly technology companies, which is to say the upper end of the NASDAQ index. So the NDX or the QQQ, as I learned it, really focuses on some very large technology companies. And you can see that in the upper right-hand corner, the NASDAQ did break out of that wedge pattern, but then it subsequently rolled over pretty forcefully, I guess is the best way to describe it. And so this is more of a mixed message at this point. And even Andrew himself points out that it's not great action because you kind of want to see these breakouts kind of having some legs. In terms of gold and silver, that's been pretty much front page news for several weeks, and certainly late last week with the nosedive in silver. That was one of the worst since 1980. And Andrew, for his part, you'll recall, if we go back in time, those that are kind of familiar readers of his letter, he was mentioning that gold and silver were kind of in, quote, uncharted territory. And so he didn't really have official technical indicators to direct his investors to. And so a pullback like this is not really surprising. Interestingly, though, with silver, looks like it did get down into the 70s and then kind of bounce back up into the mid 80s. I didn't check it today, but a lot of strategists at the big investment houses are advising clients to stay the course. So we'll have to see how that goes. But this is the Sprott Physical Gold and Silver Trust. Perhaps the biggest sort of question mark right now in the markets is cryptocurrencies, and Bitcoin's really having a tough time here. If the malaise in digital assets gets worse, you do kind of arrive at a point where conceivably Bitcoin could go down to 50,000, and that's quite a long way down from where it was literally just a couple of months ago. Now, it's very important to remind everyone that cryptocurrencies are potentially a very volatile asset class, and it's not surprising to similarly see Bitcoin rocket back up $25,000 in a short period of time. But nonetheless, this is quite the sell-off here. It has happened before if you're a long-term crypto investor, and so we'll just have to see where the I would say chips fall, but I guess the more appropriate term is the tokens. So we'll see how that goes. And then just in terms of how bad the software situation has turned recently, this is Constellation Software, and not to cherry pick individual equities, but if you're a Canadian technology investor, Constellation Software is sort of, the equivalent of saying, maple syrup. It's sort of a household name, and they had a tremendous run. They never lost more than about 30% up until recently. And so you could see CSU shares rolling over by 60%, 60. That's quite a turn of events. And, if you're a fan of the company, potentially an opportunity, but, just be forewarned that it could get worse before it gets better. And then a few other slides here. This is a tech software ETF. Not really familiar with it myself, but I think it is sort of more heavily weighted to the software as a service area, which was sort of the last, I guess, epoch in technology, if you want to say it that way. That was a huge long runway that looks like we're getting to the end to potentially, and certainly this ETF reflects just that. And so we have talked about the fact that maybe AI is going to kind of muscle out traditional SaaS, which is software as a service. So we'll see how that goes. And then one more here is this is the Webbush AI Revolution ETF. And this one's more focused directly on AI, which has also come off. And we've seen companies like Palantir and NVIDIA also have some struggles here. I don't know if NVIDIA reports today or yesterday. I kind of was preoccupied with other things. But this is sort of the thing I get out of all of this is diversification is going to be your friend. And sometimes it's great to have the growth that technology can bring. And other times you want to hedge your bets. And so last chart here for myself, David and the team is NVIDIA. The 2,000-pound gorilla in the room is looking looking a little bit precarious. It's right around here at this 200-day moving average. And if that level doesn't hold, it could get problematic. Thanks very much. I'll pass it back to the group.
Okay, that's great, Joe. Good update, and congratulations on that one win. 10Xs don't come along very often, especially in the private space. So well done, and yeah. So pat yourself on the back and get a longer arm.
Yeah.
Yeah. Okay, Ken, over to you.
So February 5th, just going over some technical and fundamental data like usual. Looking at the disclaimer here in Canada, like Joe said, not offering securities advice today. And then same thing for our US viewers. We're not offering securities advice. Contact us today through our website or email if you have any questions. Looking here quickly at the S&P, 3-box pullback this week. Obviously, really, the last Friday was the big sell-off after Kevin Warsh was nominated. Funny enough, the odds markets the day before were saying one of the top executives at BlackRock would be the nominee, but nonetheless got Warsh, who's historically been a little more hawkish. We'll have to see if that happens this time. He was only a Fed governor, I think, for one term, so I think it was 5 or 6 years during the Bush-Obama era. But nonetheless, the market didn't really love that, so we'll have to see what happens there. Within earnings, obviously a pretty big week period. AMD lost about 17% yesterday. It had a double beat, but had a really disappointing forecast from what I was reading. And then the CEO kind of had to put out some statements saying demand is not slowing, but the forecast kind of implies it. So perhaps some of these AI names, especially some of the hardware ones like AMD, maybe the steam is slowing. So something to watch there. Current momentum flipped to negative on the monthly basis to end January, and that was really to do with the last 2 days of the trading month last week. Overbought, oversold 11%. It decreased week over week, and that's the lowest of this year. And then the PE ratio still pretty elevated, about 28 times earnings, trailing 12 month. Looking here at the NASDAQ, a 6-box reversal here, new sell signal. That's the first since November, back to the support we had at the end of last year. Obviously, a bit of a tech sell-off, like Joe mentioned. I have a couple slides at the end here talking about that, but nonetheless, a pretty large pullback. You can see, obviously, down year to date for the NASDAQ. Only 5 weeks. It is important to note we're not overreacting right now, and it's only down like a percentage. But something to note. In terms of the technical indicators that we look at, price objective, momentum, supply and demand, which is measured by overbought and oversold, all pretty negative. The NASDAQ really turned over in terms of its technical data indicators. And when you look at it on a fundamental basis, quite expensive at trading well above 30 times earnings. On a trailing 12-month basis. Looking here at the Dow, actually did the reverse of the NASDAQ. The NASDAQ kind of pulled back to a support line, creating a sell signal. The Dow is back at this high that we've seen 4 times prior all this year at 49,600. This is the 5th time it's been at this resistance line. It has not been able to break above it, and it's been trading in this zone for a few weeks. But really on the technical chart, no real breakdown recently. Kind of has some nice support. If it can break above this channel, it would show some real strength for the Dow. On a fundamental basis, much more attractive. Overbought, oversold, 43%. So the NASDAQ 100 oversold by about 30%. The Dow overbought by about 43%. So a bit of rotation, I think, into value from some investors who are perhaps taking some profits or perhaps de-risking their portfolio. Looking here at the TSX 60 for us Canadians above the border, 4 box decrease week over week. It obviously had the big pullback, which was led by precious metals prices, led by miners. The rebounds kind of started to move higher. Energy prices, even though they're still, oil prices, even though they're still trading in the low 60s, energy stocks have performed very well, even the ones tied to oil and not natural gas this year. So pretty happy that we added some exposure in the fall timeframe when we thought that they had bottomed. Support, you can see 3 and 5 boxes lower. P ratio trading in the low 20s, so still pretty attractive, I think, from that standpoint, and compared to other opportunities, obviously, within the indices space. Overbought, oversold 15%. That's the lowest other than last week since November 21st. So a real pullback after the TSX was really being overbought at levels that I had not seen on these data sets. Going back 10 years. So some real strong demand, it seems like, after years of underperformance relative to the U.S. indices. There's some appetite for Canadian equities, especially because of the commodity cycle we seem to be in. Looking here at the VIX, really just continue this break upward. You can see we're making higher lows. It's been basically this staircase all the way up from the bottom in December for basically the last 8 weeks. Created 2 new buy signals. That's 6 straight. That's the longest streak dating back 2 years. Obviously, the 4% increase we saw last week was on Kevin Warsh's nomination. There's some software worries, like Joe mentioned. And then a pretty big earnings week. I'd say that there's been a little less vol because of the earnings, but nonetheless, a couple big factors, obviously. And then when you add on tariffs, uncertainty, Trump, and geopolitics, we'll say, really some prevalent risk factors for investors to monitor. Bullish percentage charts. These 2 charts have not turned over. It's important to note the NYSE has not turned over despite the S&P turning over. Which is very interesting. Obviously, S&P proxy for large caps, NYSE the entire universe. And for a while, we were saying that obviously there wasn't as much participation. It was a lot of the large and mega caps that were participating in the run up that we saw last year. But this chart would reflect that now there's a little more breadth than we saw, obviously, last year. And we know that because of the recent performance of some of those Mag 7 companies as well. But just kind of another confirmation data piece, I think. Percent positive trend, no changes on either of these two. The Dow remaining at 82% here, 82% of the companies in the Dow Jones Industrial Average trading in a positive manner. Really reflects, like I said, the strength in the value names and the value indice. Like I said, the strongest setup for an index in terms of technical data. And then looking here at the Toronto Stock Exchange, we've got a bit of a pullback in the bullish percentage chart, probably to do with the large sharp pull down we saw last Friday in miners prices, and the sharp pull down obviously in the price of silver and even gold to an extent, but still elevated relative to the last few years. We're monitoring these, but still these two charts do, despite the run that Canadian equities have been on, point to potential further upside. So something we're really watching there. Looking here at the asset class rankings, this is the first time domestic equities has not been number one in a year. So a bit of a reversal there and some continued inflows in international equities, especially with European emerging markets and Latin America leading the way. It's not for once, I think I would have to look up their data sets. But historically, whenever international equities is this elevated in the rankings over the last 5 to 6 years, one of the two Asian Pacific markets, either developed or emerging, have been at the number one position. And that's not the case this time, obviously, with some risk occurring in the Japanese market, but also the Chinese market on the emerging side. Looking here at the domestic equities, this is where the most movement has been. Tech dropped 3 positions this week. Just a few weeks ago, it was above 200 buy signals. A month and a half ago, it was above 215 buy signals. Now down to 175 and dropped 3 positions with some strength in industrial names, basic materials, picking up some buy signals this week. And then energy, one of the real movers this year or the last 2 months, gained 13 buy signals. It was below real estate, I think, but I don't know the exact time frame, but sometime in December. So in a matter of 7, 6, 8 weeks, energy has gained almost 100 buy signals. It gained 13 this week, and I think investors are really underexposed to energy names, especially with the price of oil where it got to last year into the high 50s, and this obviously rotation into cleaner energy, and Trump's drill baby drill mantra, we'll call it. I think there are a lot of investors that could use some energy exposure because I think a lot of the quality names are going to be producing some strong numbers, which are going to lead to higher equity prices this year. Just looking over the sector spotlight quickly. I'll be very quick here, but wanted to look at this. This is as of yesterday, so it's a month and 2 days. But just looking at the returns so far in 26, obviously, like I said, really stemming from commodities. You can see obviously down in the energy space in the bottom right in the basic materials space. No red in those areas and some of the brightest green charts. And then, like I said, we're seeing this continued rotation into some defensive names. You're seeing consumer defensive. Most of those names are green, farming, green. That's a little more cyclical, but nonetheless, you're seeing this rotation away from cyclical and tech into what I think are more defensive names and cheaper valuations in some value stocks. And that's kind of the case that I think will continue this year. I think these valuations are quite elevated. I think investors want to see obviously returns on the investment that these companies are heavily investing into AI. and I just think there's going to be a large rotation, and I expect that to continue. The other thing I wanted to mention, obviously, correlates with what Joe was talking about earlier. Software stocks, some of the biggest losers, especially when you look at a industry by industry. There's nothing close to what these names have already lost this year. And then quietly, regional banks, one of the strongest subsectors in the U.S. this year. Really cheap valuations. Dave's talked about them on this call numerous times. We own a few in our stock platform, and then also there's some exposure through the alternative asset trust in a regional bank manager. We think there's going to be increased deal activity in this space. The valuations are highly attractive, and some of the balance sheets are in really good shape. So something to note there for an opportunity. Looking here, this is the daily distribution returns for SLV and GLD. You can see the daily average. This goes back to 1990 for SLV, 1975 for GLD. And you can see where it's sitting. These are obviously some distribution charts for those who took statistics or data management. But you can see how much of an outlier both of these charts have, and they both stem from obviously last Friday, like I mentioned, when we saw massive declines in the price of silver and gold, really stemming from worries, I think, from Kevin Warsh being nominated, and he's a bit of a hawk when it comes to inflation, which could lead to higher rates for longer or a period down the line of higher rates. But I also think that the melt up that we really saw in silver and gold was a bit overdone in recent.
Ken, before you go on, go back to that slide. It's very telling. It's a great thing you found this. You look to the far right, greater than 5% gains in a day has happened very rarely too, but only 5%. Whereas for gold, it's negative 10, and for silver, it's negative 20 to the far left. This is such an outlier situation, and I'll sound like some kind of a conspiracy theorist, but there's going to be evidence that there's some prime banks, some major banks in the U.S. who've been short these two commodities on their tremendous rise, and it almost appears that they waited till a Friday, which the 30th was, I believe, to orchestrate some sort of massive decline. Work together, perhaps. I'm only speculating here. This might all be incorrect, but for them to try to recoup some of their tremendous losses that they probably have buried in their books. But the reality is these two commodities trade as physical commodities in other parts of the world, in Asia and those prices have not seen these 10 and 30% declines that we see on these screens. So this is just paper that was being manipulated, in my opinion. These are all just my personal opinions, by the way. I might be absolutely wrong, but I don't think they'll be able to orchestrate this again, especially based on statistics. So thanks for pulling that one up, Ken.
Yeah, no problem. Just just wanted to show how much of an outlier, and even beyond that, like just the run that they've been on, 100%, 150, 200%. Some healthy pullbacks. When we look at these technical charts, we want some support for some entry positions, and you can see just the run we've been on since the start of 25. Pretty large drop back you can see on this silver chart, but it's back to its 50-day range, or 50-day moving average, and two strong lines of support. So perhaps on the technical data chart, something that benefits the price of silver down the line, and especially the silver miners that have unhedged books and are producing. Okay, beyond that, we're looking at we're looking at the IBIT chart, which is the iShares Bitcoin Trust ETF. My apologies, I got confused there. I was looking at the scale and was naturally looking for the Bitcoin scale price, but this is just the ETF. Massive sell-off, obviously Bitcoin trading in the 70s now. The fund score here is 0.6 out of 6. it's pointing even lower. There's really not been the demand in the crypto space that many expected last year, and that we've seen in previous cycles. Obviously, there's always downturns in these Bitcoin cycles, but in a period when gold and even silver and platinum were going kind of gangbusters, Bitcoin did move the other way, really, and moved lower. You can see here, this is the Bitcoin bogey check that some technical analysts, including Dorsey Wright, use, that just tracks Bitcoin versus the typical money market fund. Bitcoin's currently falling relative to cash. And the last time it did that was 2022, and it fell for quite some time. You can see the numbers on these charts don't mean anything. It's more trend analysis that you want to follow. But if it does create a sell signal, the last time it created a sell signal, it created 2 straight. And you can see these prolonged periods where even cash, money market funds are in favor relative to Bitcoin. So something really important to watch. Beyond that, wanted to just talk about strategy. He's basically leveraged his whole balance sheet to the price of Bitcoin gobbling up. I think they hold almost 1 million Bitcoin now. You can see the stock price of his company over the last year compared to the S&P year to date, and these losses continue to accelerate. I had read that many speculators thought that he would likely be margin called because his average purchase cost is sitting at about 76, 77,000, and the price of Bitcoin dipped below that. But reportedly, the way he's pledged the Bitcoin, they aren't. He won't see margin calls. They're all unencumbered, and he apparently has pretty strong flexibility around his convertible debt that he's issued to buy these Bitcoin in the near term, especially. I think the nearest maturity for those notes come in 27. So, I mean, it is a year or maybe 18 months away from those maturing, but probably some near term margin or issues for him. He just might get continued selling from his shareholders if the price of Bitcoin doesn't turn around. Just a few more slides for myself. These are the prices of crude and gas, which have both turned higher. I had mentioned the start of the year, it looked like a bottom was in for both of these 2 charts, and it looks like that's occurred. Oil now trading, as of I think this morning, below 60, 63, 64, somewhere in that range, and really breaking above this trend line, which is back to a positive trend for the first time in 8 months. Gasoline, similar move. Obviously, the scale is much lower just due to prices. And then just quickly here, looking at the emerging markets ETF versus the Russell mid-cap ETF, and then over here, the Pacific ETF versus the S&P 500. We're seeing upward moves, which means strength for the first listed security. So emerging markets gaining strength versus U.S. mid-caps for basically the first time. This is the first buy signal since 2017 when Trump was first in office. And then going back further, the real long-term strength that we saw was in between the dot-com bubble and financial crisis, when global equities outperformed U.S. equities. And kind of a similar-ish story to the Pacific ETF, but no kind of short-term strength in there in 2017, and no real sustained period there of outperformance. But nonetheless, these 2 charts did turn over, so perhaps taking some international exposure could be of opportunity for some investors. Just wanted to highlight this chart. This is more up Joe's alley, but these are Forbes put together an article that I read. I got it sent to me from a friend, and it was, I'll try to send it around later, but it was just talking about mid-market what they call zombie private equity funds, $130 billion across 20 firms. You can see these are, I think, 10 of the bigger ones, and then the list continues. I just didn't have space. And none of them have had no new flagship funds in the last 5 years. Obviously the top of the market, the blue chip PE giants like Blackstone's of the world continue to perform quite well. A lot of these firms haven't been. They have limited their distributions, obviously, and that's been led by fewer exits. And then in this chart is just from Preqin, but it's from the Forbes article you can see in the bottom right. And it's just tracking the number of funds by year and the average holding period for investors, which has increased over the last few years marginally. But you can see PE firms are just generically having a harder time selling the companies they own. And there are a number of reasons why that is occurring. Obviously, you can see the stock prices here this is a different article. I just found all this information this week, but I think they kind of relate just because PE firms were buying up all these software companies for years. And now, one, they don't have as many exit opportunities. Two, AI is disrupting them. You can see here, there's a number of PE sponsors, their stock price returns in public markets since I think the start of August. Some massive negative returns. Obviously, investors are worried regarding exit opportunities. Obviously, we've had some higher for longer interest rates. There's been limited deal activity. There's been global uncertainty, tariffs, which are impacting these sponsors. But I think generically, a lot of them are sort of not all of them, but some of them are leveraged to a lot of software companies. And as Bloomberg put it, the SaaS apocalypse is underway. And last year, even Apollo, who is share price is down about 11%, so one of the better ones on this chart, one of their senior executives told their audience that the largest risk facing private capital markets, equity and credit, is the death of software. And these AI companies continue to disrupt. And like Joe said, one of the best companies in the software space, Constellation, up here in Toronto, down about 55% over the last little while. The disruption is real, and I think it will continue. I think some firms will make their way through it, but I think there will be some names that continue to have negative returns, obviously, in the software space. And I think that's it for me.
Excellent, Ken. I'd like you to go over the weekly beacon as well, like we used to do on a weekly basis as part of this.
Yeah, for sure. We talked about a few things this week. I think I remember everything I talked about. So Dave, just feel free to scroll through while I talk. I talked about the new nominee for the Fed and how he wants to decrease the Fed's balance sheet, and if that's possible, and what happened to the public markets after Warsh was nominated. And then I went into a few other interesting things that we're always looking at. Elon Musk really beginning to consolidate his empire, blending SpaceX with his AI startup XAI. And remember, last year he blended XAI with X.com, basically Twitter. So really seeing continued consolidation in his neck of the woods, and what that means for a potential IPO, we'll have to see. Then I talked about a utility company that we own in some client accounts. It's a diversified company that basically generates power and provides it to corporations and some individuals. And they're apparently a buyout target for BlackRock's infrastructure fund and EQT, a Swedish investment firm. So really interesting. We've seen a really hard move upward in the share price of that company in recent months. So something we're continuing to follow, obviously. And then, like I said, looking at the risk of software, AI adoption, how it's going to impact software versus hardware, i.e. semiconductors. Really big spread there in terms of performance, and we think that'll probably continue. And then I think the last little piece that I wrote about beyond software was just a piece on PE and private equity managers seeing some large drawdowns in their public stock market share prices, and how that's really accelerating negative returns within that space, but it's also being led by their private market returns and management fees. And it's being driven by a lack of deal activity and an IPO drought and higher interest rates and a number of other risk factors, including things that impact private credit markets and not private equity markets. So a really diversified issue, I'd say. And then quick piece on what we're looking at next. Gilbert writes a nice little piece here, just looking at the CPI data, more inflation data, what the Fed's going to do, if they're going to be as restrictive. We'll have to see. So yeah, a nice issue. I think it gets released tomorrow, and we'll pass it back to Dave.
Excellent. Thanks for that, and great presentation today as well. So everybody look for this in their inbox tomorrow morning at around 8 a.m. And as always, just check in with us if you have any questions or comments. Okay, so now I'm going to go on and share my screen. Okay, I'll start with Michael Coolbaugh's work. So here he's off on gold and silver. See record call buying. So that doesn't really even show that massive one-day decline, but this was put out after that. Trading FOMO, not fundamentals. Citi raises silver price target to 150 from 100, citing strong speculative demand. That right at the peak, they of course came out with that. Citi, not good on them. Parabolic moves are dangerous. Past instances where silver has gone parabolic to a similar degree saw prices flat to lower over the next 2 to 3 years. Okay, so he's going back to 1979, 1980, where the Hunt brothers tried to corner the market here in silver, and it did have a parabolic peak, and trying to liken it to right now. We'll see. As I said earlier, there's the trading of physical silver is really did not have this type of setback. It's really the paper silver that did, and I personally believe it's more of a banking thing than it's a supply demand. There's just not enough supply for the demand out there, for everything from EV cars to cell phones. Silver is in way more things than you would ever imagine. Okay, on to elections. Midterm elections years typically see equity weakness at the beginning of February and then a steady recovery in the back half. Okay, we shall see. Cyclical recovery. Last week, we shared the signs of stabilization in multifamily building permits. Now, ISM is reporting a massive jump in its manufacturing index. New orders jumped to its highest level since early 2022, when the Fed began aggressively raising rates. After a prolonged manufacturing slump, we could be seeing signs of a cyclical upswing. The lagged effects of rate cuts plus pro-fiscal tax policy kicking in together in 26. Okay, tender rejections continue to surge and hit a new post-22 high. The drawdown in 22 was the start of a multi-year freight recession. If orders are starting to rebound while capacity is constrained, pricing will continue to improve for the trucking industry. More signs that the labor markets is stuck in this low hire, low fire environment. We are seeing hints of an AI productivity boom. Okay, that's a question from him. Chevron, given the geopolitical situations in Russia, Ukraine, and Iran, I forgot about Venezuela too. Oil will swing based on every headline, but don't lose sight of the fact that Chevron just reported that its oil exports from Venezuela more than doubled in January. We still believe Chevron will be one of the primary beneficiaries of the regime change in Venezuela. Yeah. AI build out. If we were seeing a cyclical upswing, might investors continue January's theme of rotation? This is Oracle's projected free cash flow through 2030. That's a lot of time for something to go wrong with this massive AI build out. Bitcoin. We don't trade Bitcoin, but for those who do, the 74 to 75,000 area seems to be extremely important. As for the whale in this industry, Strategy, formerly MicroStrategy, I wonder how much he paid in legal fees to make that a significant name change. What a waste of money. We're right around Sailor's long-term cost average. Do what you will with that info. Okay, now more. What's he doing here? Is Warsh a permanent hawk? Yeah, this doesn't really add up. Trump, he's been claiming that the current Fed Chairman Powell that he put in back in 2017 hasn't been strong enough into lowering rates, and then he brings in this supposedly hawk. I don't get it. It's just. And how are they going to control inflation without massively raising rates, like happened back in 79 and 80 with Paul Volcker? So this is just baffling me as to what's happening here, but time will tell. That's the end of that slide. Sean, I had a quick look through yours. I look forward to hearing from you shortly after me. I'll be done in a little bit here. Okay. What's going on here? So the year to dates is the column I tend to focus on. Got some negatives in the NASDAQ and negatives in India. And largest gains are in the venture capital, Canada, and green everywhere else, including Italy and Japan. That's had a nice recovery, even with their interest rate challenges. Nothing really else to see there. This is where you get these. Let me just move up here a bit. So we've talked about silver and gold already, but there are the weeklies, down 7 and down 25. It was basically in one day. But silver still holds out as the champion in the 10-year race, higher than everybody else at almost 19%, even ahead of the NASDAQ, believe it or not. So yeah, maybe we did say a while ago that silver was getting ahead of itself, but who knew it would collapse to that degree before it bottoms out here. I'll talk about the Canada US dollar later. We've said enough about Bitcoin and interest rates when I go over to the the playbook. So let me go find that first. And I'll share again. Okay. Here we are, the Canada US dollar, 73 cents still, hasn't really moved in the last week. The short term has it up to 78, which should be a problem for our US holdings. That 5-cent move would be harmful to our US holdings. Or the long-term indicator has it down to 62. So I'm guessing that this is going to sort of stay in this range, but trying to predict currency movements is a real mug's game. Yeah, I've long ago talked about a story when I worked at Citibank. It took out Castles Blakey, where I was working in one of my second job. And so all of a sudden I had Citibank, and one of my roles every week was to get the head currency trader of Citibank on what was called the Squawk Box every week to all of the portfolio managers and brokers at my firm I worked at. Anyways, I got to know this Citibank trader quite well. They were at the time the largest traders of currencies in the world, so you would think that they really knew everything. And after a year, everybody in our room went around the table and we all agreed that they had no clue where they were going. So it really, truly is a random walk, currencies. But this is why I like to use point and figure, because you do get a bit of a trend following out of it. So the US dollar spot index is at 98 now almost, and it looks like it could go higher. And that's sort of opposite what you hear of everything else. So we'll see if that trend comes true or not. The U.S. economy is doing better than people, they underestimate it. It's probably the best way to explain it. Okay, crude now measures up to 81, nat gas down. So nat gas, that $9 target is now completely disappeared in the last little while. And these are just mathematical estimations, so you can't sort of run them as a fund. Anything else to highlight? Yeah, uranium's rolled over, and gold. Yeah, gold is rolled over big time, with the futures measuring down to 3,200 and the spot price down to 4,000. So we could be taking a pause here with those, but until we see and really can understand inflation being under wraps, we'll continue to hold in here. What else? Yeah, like silver measures down to 25. So we'll have to really pay attention here. Maybe take some more profits in silver. That Bitcoin number has changed over the week too. It used to be in the 200,000 range. Now it's down to 48,000. So those in the crypto space might be time to get out of the way there. And then finishing up, the banks, U.S. banks, whoops, we're just at the top of my screen there. Come on, baby. 173 up to 198, and the regionals even better, 72 to 87. So in Canada, even better. This is the equal weight of all the Canadian banks at 60 up to 103. So that tells you something. Rising rates is also good for the banks too, but getting there is painful for them. It's like owning a long bond. Finishing up with interest rates. Nothing's changed with the 2-year, still at 3.5, measuring down to 2 3/4. The 5-year up, the 10-year up, and the 30-year down. So nothing's changed there since week over week. And that's the end of my discussion. I'll pass it over to you, Sean.
Okay, we've got a lot to talk about. Let's get into it. I don't know who would want to take my advice. The returns have not been very fun. I thought I was doing okay last week. We have a very high cash position, and my portfolio allocation to base metals is growing, primarily copper. I'm still keeping an eye on the debasement trade. I don't see a path forward for the United States other than inflationary debasement. I own some tech. I bought Constellation Software recently. The crypto market, I've been saying on this call for a couple months now, the crypto market's broken. Okay. I'm not seeing a good use case for Bitcoin. The legislation that is needed to advance crypto in North America, where we already have frankly, a great monetary system, that legislation has been kicked to the curb by the banks. They don't want capital flight out of their deposits and a contraction to their lending base. If the Clarity Act was passed the way that Coinbase wanted it, we would see Coinbase ATMs everywhere probably in 6 to 18 months. They would be as prolific as TD Bank became in the US, but that is not happening. I'm not sure whether the bank lobby is going to keep pushing this, whether they're positioning for it, but the crypto market right now is uninvestable. Okay, big picture, what's changed? We'll talk about the admin put that I see being in place because of midterm elections. Copper, I still like probably as the best underlying asset going forward. I've got an eye still on the yen carry trade, rising yields there. Right now, man, it looks like there's no way the Republicans are going to hold the House after midterm elections. Asset classes, gold is still up, crude is up. We'll talk about that in a second, but Bitcoin and Ether are just in the dumps. Everything else is pretty flat, and we'll get into that. Economics, pretty much the same as last, but the Atlanta Fed nowcast is pulled back by 1.2%. Notably, the ISM, the Purchasing Managers Index, is up above 50. That's expansionary. But the Regional Fed Manufacturing Index tell a different story. I'm not sure what's going on here, right? We could be seeing expansion based on data centers, on gold sales. we're in a very choppy place right now. The one thing I will say is I expect inflation. We'll talk about Warsh in a second. Okay, the key is unemployment. It's softening, definitely softening. Skip the government numbers and look to what are private companies actually doing. The actual number for ADP came in half of forecast. Amazon is leading the way in laying off corporate jobs. These aren't guys packing warehouses. These are guys making like $100,000 plus doing marketing, developing, all kinds of things. And the Fed is watching this. Okay, now this I found fascinating. We're getting the band back together. I don't know if anybody here is young enough to remember the Blues Brothers, like Dave and I. So Kevin Warsh, after the Fed, who did he work for? Stanley Druckenmiller, probably one of the greatest investors of all time, next to Dave. And who else worked with Druckenmiller and Warsh? Scott Bessent. The band is back together. We have a data-focused duo leading the economy with deep experience in markets, with a mentor who's a genius in the space. And we have a Treasury Secretary who comes from Cantor Fitzgerald, but he might not be long for this world given his relation to Epstein. Rumors are that Trump is going to put him out to pasture as an example. But frankly, in my opinion, we actually have a market dream team between Bessent and Warsh. And this gives me a lot of confidence that they'll navigate market dips and be market focused. So to me, this implies an administration that's focused on the market, that will reinforce by the dip, that will take action if we are down 15 to 20%, as we saw last year in the tariff tantrum. Okay, US dollars had a recent pop in a little while, but the trend is still lower, right? We're going to have this inflationary trend. Trump has said, Warsh is committed to cutting rates. A lot of people talk about Warsh being a hawk on inflation, but when you look at guys like Neil Dutta, that's analyzed the last 6 months of his statements, he is going to toe the line. Gold is still in a bull market, right? It had a big pullback, and we'll get into why. Okay, so China is diversifying out of holding US dollar assets, right? They know that the dollar can be weaponized. China is clearly on a track to 2027 to take over Taiwan. They've been dismissing generals that keep telling Xi, this is maybe not such a good idea. Guess what? You tell that to Xi, suddenly you're out of a job. Look at the number of generals that are out of jobs. Like, these guys are like the grandkids of people that participated in the Cultural Revolution. Like, he is purging until he finds people that says, yeah, I'll get you Taiwan. In gold, we do see strong margins continuing. I'm expecting an M&A boom as a lot of juniors get swept up by these guys that just have enormous cash flow. Silver, okay, in my the last couple reports, especially last week, I said this is speculation, right? We had a parabolic move with a lot of gaps, pure speculation. Okay, there is nothing fundamental about that move other than people chasing gold through a lower priced asset. Silver is gold's crazy cousin. Chinese exchanges were offering 50 times leverage. So exchanges like Binance and some of these others, probably BitMEX, they offer 50 to 100 times leverage. And if there's one thing that can make a market go parabolic on the way up and parabolic on the way down, is extreme leverage. There's a great book called Brief History of Financial Euphoria, and that goes back all through history. Leverage kills, okay? My target, based on the rise of gold, copper, and other base metals, would put a reasonable number on silver at $50 to $60. Okay, that was a dramatic sell-off, and it started in China when unwind started happening due to guys getting washed out due to margin changes over there. The fact that real companies that use silver were complaining to the government that they could not obtain actual physical silver. And the government probably called the exchanges and just say, hey, like, reduce the speculation, and it fed on itself. In my opinion, Warsh had nothing to do with this. And then the CME follows a process based on implied and realized volatility and price movements, and they changed margin requirements. I had a model of this that I hadn't paid attention to for like a decade. There's a researcher at the US Federal Reserve that built a model. When does the CME change margin? And silver was literally the poster boy for a change being required, and it got hammered, right? Like you had a global asset change, fall by 40% in a day. This was just unbelievable. Can it fall further? Probably. We're going to see a lot of chop until it settles. The other big thing, as Dave mentioned, JP Morgan had a massive short position, and it seems like they have taken advantage of this big sell-off and changed their positioning. Okay, and that comes through like the plumbing of CME, where they have this commitment of traders report, and it's defined between small traders, large traders, and commercials. You got to look at like, what are the producers doing to hedge? Who's doing the hedging for them? So like that print says that JP Morgan has covered in an enormous amount of their short. That represents 3 million ounces of silver. 3 million. So that's the transition from paper to real. Copper, I continue to love copper. You got Amazon buying copper contracts, for God's sakes. The defense industry, which is, sending enormous amounts of material to the Ukraine, they've got to restock. I just think copper is going to do well for a long time between electrification, EVs, and data centers. Oil, a lot of people have talked about the breakout. I just see this as a bit of speculation on Iran. I expect Iran to be resolved in the next month or so, and we will get back down to a downtrend. We could see oil in the 40s here by summer. Oh, and nat gas, fully back to normal, right? That was like, guys got short squeezed. We had a massive pop. Everything is kind of thought out. Distribution hasn't been imperiled like they thought it would. We're right back to where we were. Rates and credit, pretty boring, except watch high yield spreads. I think high yield spreads are going to become higher yield spreads. Like we're seeing that in private credit, as has been mentioned with Blue Owl, KKR, Ares. A lot of these guys are finding, deals are getting pushed. And, remember, a bond or a loan is a contract. Equity is a promise. So first, what I've seen in, not so much in 2000, in 2008, when contracts break, then promises break, right? And equity is a promise. I promise to make money. I promise to have earnings. So, I'm on super high alert. Not yet, but we'll talk about that. Equities, we still see this resistance with the S&P at 7,000. Breadth is good, getting broader. The VIX term structure is good, except when I checked before this call, spot VIX is above the front 2-month futures. That tends to precede an inversion. An inversion represents a small panic. Are we there yet? I don't see it. The MAG 7 generally met expectations. Sentiment has softened a bit back to neutral. S&P, you look at the slope of this curve and it sure looks like momentum has declined, right? We're seeing a little bit of some spots of red in the heat map, yet we're not seeing high pressure. We're seeing a supportive VIX curve, and breadth is still there. However, I did buy 5% out of the money June put on the triple Qs. Again, one of my favorite charts, thanks Gilbert, is, we're heading into midterms. These Epstein files just keep making things look worse and worse, but people are not outraged yet. But I don't think between that and the ICE killings and general sentiment that the Republicans are going to have a good time. They lost a seat in the House in Texas. I think that forebodes a pretty tough next couple of years in terms of getting things done fiscally. Crypto's crapo, right? Crypto's crapo. The bear market continues. I thought there was a base around 90. Wrong. Like right now we're at $68,000, and I've been fielding calls yesterday and today about people selling, and I'm not talking about selling like a bit. I'm talking about like some of the people I know selling $10 million of Bitcoin today, for example. Where's the downside? By my estimation, about 45,000. October, November is probably when we get there. This is not working as a debasement trade. This is a broken asset. Whether guys are piling on, I don't know. This is such a big asset that I'm not going to, concede to a conspiracy. It is just absolutely out of favor at the moment. If you have to take exposure, the Bitcoin Treasury Company here in Canada is trading at a 36% discount to net asset value. Here we see Bitcoin again, broken. Like my heat map is red top to bottom. All the trends are down. If anything, it's like oversold at the moment. Again, the chart, we're in the fourth year of a 4-year cycle. Typically, we go down 60, 70, 80% from previous all-time highs. All-time highs being 26, we're talking 40 grand. Altcoins are even worse than Bitcoin, right? They're like beta 3 to Bitcoin, if you will. And I don't know where the bottom is on this. My favorite trade right now, I'm still long the 2-year notes. The Atlanta Fed is coming back into what I thought it would be. However, the ISM printed above 50. I'm scratching my head. I'm watching unemployment. I like the appointment of Warsh. I think that we may be seeing a bit of dollar strength because people are buying, treasuries right now. So here's the 2-year note future starting to work. It's a pretty levered position for me. So, up 7 basis points is like probably, multiply that by a 10x for the leverage. Talking about Cuba, we'll talk about that more another time. Figuring it out, the big thing is, I see Trump becoming a lame duck in November. Trying to figure out the implications for that. I talked about my number one point last week was, do precious metal continues gains? Obviously not. The margin change just changed everything. The major commercial hedger, JP Morgan repositioning, very interesting. But, it is still a needed metal, but it certainly kneecapped a bunch of speculators. I've got a short on Tesla, ending the Model S and X and going in and talking to people at the Tesla stores. I don't have a great feeling for where they're going. And now Elon's focused on, getting SpaceX and XAI together and out the door. Like Tesla's going to be the sad cousin on this one. Okay. Tesla, because it's a cult stock, you always have to have a stop loss in place. But again, you see on my heat map below the price chart, the 8 technical indicators are just showing the forward prediction of momentum over the next 20 days is low. And then finally, you got Jeff Bezos. Guys, you may want to learn how to mine coal. So that's it from me, guys.
Yeah, the coal trade's done very well. Our value managers in Australia have been long coal for some time, and they don't really care about the negative consequences or the environmental side because it's still being used in great gobs in China and India. And
there's a Canadian company called Colonial Coal. The ticker is CAD on Vancouver. They have metallurgical coal in British Columbia. And the BC government is supportive of somebody buying them and developing it further, creating jobs, and then loading it onto Union trains to Union ports. Anyway, that is one interesting play in Canada where, for example, India needs a ton of metallurgical coal, which is specifically used to create steel.
Yeah.
Anyway, if you guys have any questions on silver or Bitcoin, lay them on me. But
no, it's pretty clear. Both markets are, they're not comparable, really. Like, I totally agree with what you said on silver and just the lack of supply for those actual users. That's a real thing. Okay, well, I'll go on mute. And thanks for that, Sean. Over to you, Chris.
Great. Can you guys hear me? I think my mute button's off. Thumbs up. Great. That's old school. Love it. Always helps to have some old school when you're dealing with technology. I did want to ask Sean a couple of questions. I mean, this Saylor guy, sort of intrigues me. I can't really, has he ever presented what his sort of rationale for this company is beyond just that Bitcoin is going to be a fantastic asset and, he owns a lot of it. I never really understood what the business, case was for buying it. And then, the other part of that was that, maybe back in the fall, you were talking about an arbitrage with a Canadian Bitcoin debenture company. Just curious what happened to that. But you covered the Warsh nomination, very well, and the links through Stanley Druckenmiller with him and Besant. And I think the Wall Street Journal had a pretty good article about Kevin Warsh and how he's, sort of a consummate networker and really had, connections running deep through the Trump organization and the Fed. And I think the view is, I'm sure, Besant ran the program, and I think he feels that Warsh is a guy that he can work with to achieve, what he sees through monetary policies. It's also pretty clear to me that Besant is, not sticking around if Trump is gone. So that's why I think he didn't want to take the chair position. But I'll go back on mute because I'd like to hear Sean's answers to the, what is Michael Saylor's, business case? Is he going, and will he go bankrupt? And then also that arbitrage you talked about way back on the Canadian company.
Okay, so the bottom line for why did Saylor initially put $400 million of cash that was on their MicroStrategy balance sheet at the time into Bitcoin? It was like he looked at the monetary, the growth of the money supply in the United States was growing at 17% a year. And he felt that was inherent debasement. And so he looked at what other assets that could he hold if they wanted a treasury asset that would not lose purchasing power. He looked at gold, but there's a cost to own gold. There was security issues, and there was even the issue of potential confiscation. And then he decided upon Bitcoin. His company is about computer science and applying IT to businesses. He had a bunch of people deeply understand the code, and he said Bitcoin is real. And then he picked Bitcoin, and then Bitcoin rallied on basically the 4-year cycle that it goes in on debasement and on his cult of personality. And it has worked for him. He's levered the company up. It is a financial engineering machine right now. It is not something that I like anymore. It's not a pure play on holding Bitcoin for people that couldn't initially access it directly or through ETFs. There are absolutely, there's no reason to buy MicroStrategy common shares anymore in my mind. You're far better off buying IBIT or holding it on Coinbase or something like that. The second point where I've been buying a lot of this company, the Bitcoin Treasury Corp, BTCT, trades on Vancouver, and you want to do that and you want to figure out how to short Bitcoin. At some point, they are going to figure this out, or they're going to be forced basically to convert that company to an ETF or roll it into one of the ETFs that evolve, and you'll gain that 36%. But right now, for the average person, stay out of Bitcoin, right? It has not found its floor, as we're clearly seeing. Despite it being oversold, it will continue to get further oversold. The use cases are not there for the vast majority of North Americans. So it's just, in my opinion, a broken asset. That's it for me.
Just one more, Sean, if I could. I'm sure you're familiar with this guy on CNBC who they seem to love, Thomas Lee, who's yeah. So he's calling for Bitcoin to hit 250,000 this year.
Well, it's not going to happen, in my opinion. I think we will trade down pretty hard if we repeat the 4-year cycle into we'll see a 50,000 handle. We might see that next week, for God's sakes. And then could we double in November and December? Yeah, but that would just take us back up to 80, 90,000. Tom Lee has, he's the chairman of a company called BitMine, and they mine Bitcoin and then they hold Ether. Okay, it's a massive conflict of interest for him to continually pump his bags. So just know, he's selling something. Everyone sells something. He is selling the idea that the price of these assets is going to skyrocket and it's going to carry the shares of his company much higher.
Excellent. Thank you. That's probably it for today, unless anybody has anything else they want to cover.
David, I can do my short report.
I apologize, Gilbert.
No worries. That's all. Okay, let me share.
So go ahead. Okay, take it away.
Okay, perfect. Thanks, David. So this is this week's short report for Thursday, February 5th. Again, next slide is just a quick disclaimer with regards to what we're discussing here. Slide after that, we're going to take a look at the S&P 500, which again, we're still well above this extended 50-week exponential moving average, which has been the support. But when we take a closer look, something that I've been looking at for weeks now on the next slide is you can see that this sort of band range that we've been in is very similar to what we saw at the start of 2025. Again, I'm not calling for a massive sell-off like what we had there, but the market is essentially stalling here, and it's been stalled for about 4 months, actually, because we got to this level in late September, early October, before we started to see this volatility. And during that time, we also got rotation of growth. That's when the rotation out of growth started. And so you can actually see that on the next slide where we take a look at the NASDAQ 100. And so the NASDAQ 100 did something very similar to what it did again at the start of 2025. We got a new all-time high. We had a lot of consolidation. And then we had another all-time high, which I think was 2 weeks ago. And that was immediately rejected, right? So all the bulls that piled in, now they're in an offside position, they're underwater, and the market has the potential again to revert. Now, the reason why this is important is because we're now at a stage where we're seeing a lot of rotation out of growth. The software as a service SellOff that's been happening over the last week has contributed to that. And we're starting to see a rotation into the safe consumer staples that we've been looking at for some time in the next slide here. So if you want to take a look at that. Oh, sorry, first we're going to take a look at the CAPE ratio just as an overview so we can once again see that we're very extended here, very expensive on a PE basis. The next slide, we can see that when we take a closer look, we get these sort of rolling over patterns, right? And so it's not just that we're trading at 40 times earnings. What's happening is that we're starting to slow down in terms of the acceleration of earnings growth here, which is what we saw in the last 3 big pullbacks in the market in the last 10 years. So if we go to the next slide, we can actually see that credit spreads remain tight. And this is what I've been pointing out for some time. Every time we get down to this level where credit spreads are tight, they start to widen. And it's because really there's nowhere else for the market to go. Historically, we've seen that it's very difficult for spreads to get tighter than where we are right now. The last time we got this tight, we had a big pullback. The time before that, again, big pullback. And we're starting to see this uptick here, which is concerning because it could mean that the market is continuing with this pullback that we're starting to see. And we can see right here today with the S&P 500 down 1.5% as of 10:30. In the next slide, we're just going to take a closer look at credit spreads. And again, yeah, we're coming off of this red sort of danger zone where things get really, really tight. Last time that happened, that was the sell-off in 2025. Not saying that it's going to happen, but we have all the markers there. Now, if we go to the next slide, what we can see is the rotation that I've been talking about. This was actually the chart from last week where we saw that, yes, the rotation started in late October and we started to move higher. But when we take a look at the next slide, we can actually see that this has accelerated now. So we're seeing more rotation out of growth, more rotation into consumer staples. And this is similar to what we saw, again, at the start of 2025, but also in 2022. So, there's a lot of evidence here to suggest that things might not be as rosy as it seems. If we go to the next slide, what we can see here is the only caveat, which is that market breadth continues to move higher. So we're seeing a little bit more participation, but the way that I see that is that we're probably seeing participation from where? Well, the consumer staple stocks, right? These are the ones that people are rotating into, and the consumer discretionary or the growth stocks are the ones that are more cap weighted. So you're not going to see more participation there, even though they're dragging the market lower. So next slide, just to summarize everything. We are technically extended. We are seeing a double topping pattern in both indices, not just the S&P 500, but the NASDAQ 100. CAPE ratio is extended. We have a precarious credit spread profile, and defensive rotation continues like what we've been talking about. So it's a skewed risk profile, and cautious behavior is probably the right approach to take today. If you are concerned about that, we at McNichol & Associates have a solution, which is our universe of partners. So if this is something that interests you and you're concerned about where the market is right now or what it's doing right now, please reach out to us. So that's it for me for today, David, and you can take the rest of the way.
Thanks, Gilbert. Yeah, no, people are optimists at heart, and they really don't think that things will ever change until they do. And you only notice things changing in hindsight. So we're very pleased to have this downside protection in place. And as I started off at the beginning, I'll just show this at the end. You can visit us in Canada here, or the US here, or take a picture and scan the QR code, and that will take you into another landing spot. And we've got plenty of content, so we hope to get your feedback, both positive and negative. We can take it. We're big boys and girls. And once again, for you YouTube viewers, please like and comment and subscribe. We would appreciate that.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.